There's only one answer: get the hell out of credit. And for the avoidance of doubt, currencies are credit. And we know that because if you look at the balance sheet of the issuer, central banks, it appears as such as a liability of the central bank. A liability is the other side of credit. It's all credit. It all depends on the valuation which creditors put on the stuff, and we can see why that valuation is going to collapse. Get out of credit, get into physical money, which legally from Roman times only been gold and, with a subsidiary role nowadays, silver.
The global monetary framework is fast approaching an unprecedented tipping point as expanding central bank liabilities threaten financial stability. Escalating sovereign debt burdens and severe geopolitical tensions are driving Western economies toward a profound currency crisis. Alasdair Macleod, a veteran financial strategist and precious metals analyst, asserts that unbacked fiat currencies are merely central bank credit destined to lose their purchasing power. He predicts that central authorities will resort to aggressive monetary expansion to bail out collapsing markets, causing bond yields to surge, stock markets to plunge, and corporate bankruptcies to spike across G7 nations. Meanwhile, Eastern economies are liquidating dollar assets to secure physical gold and industrial commodities, accelerating a transition toward hard asset settlement systems. Investors must shift into physical gold and silver to safeguard wealth before debt markets fracture. Now, we present the clips from Alasdair's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Let's face it, the Chinese are allies of Iran. They know exactly what's going on. They can see that the end of the fiat currency system has been brought forward very substantially as a result of the failure of the Americans in attacking Iran. I mean, the closure of Hormuz, it just amazes me that people just got no conception as to what's going to happen to the G7 economies. I'm going to talk about G7 rather than globally. The G7 economies, basically, it's just going to kill them dead. And what will the central banks do? Well, they'll try and support the markets. They'll try and support the economy. How do they do that? Print, 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 print. And that's what's going to happen. What happens to the purchasing power of these currencies? Down, 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 down. What happens to bond yields? Up, 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 up. What happens to the stock market? Down, 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 down. What happens to businesses? Bust, bust, bust. That is what's going to happen. The Chinese can see this. And so, the first thing they did was they started dumping dollars for everything they could. Any gold, if you got some gold, please let us know. We'll give you dollars. If you got any silver, let us know. We'll give you dollars. Copper, we'll give you dollars. Oh, and by the way, we're going to hang on to our sulfuric acid. And we're going to hang on to our fertilizers because we don't want any dollars. And amazingly, in spite of all the sort of toing and froing over tariffs and all the rest of it, the trade surplus is standing at a record. More damn dollars. We don't want the stuff. So they're trying to get rid of dollars. Now, they can see what's going to happen to the purchasing power of the dollar. They've known this for a long time. And indeed, you go back to April the 2nd, which was Trump's Liberation Day. The following week, President Xi did a whistle-stop tour around Southeast Asia, following which suddenly we found that there were plans to open for the SGE, no less, which is a purely domestic operation, to go and open vaults in Hong Kong and also in Saudi Arabia. Why? Because there were two sort of areas. Hong Kong was, if you like, the international center for China. Saudi Arabia, well, they buy a lot of oil in that part of the world, et cetera, and they could see what was going to happen to the dollar. And therefore, I tell you, actually, just as diverting just a little bit, back in 2014, I interviewed a director of a major Swiss refinery, and he was telling me they were working 24 hours a day, 7 days a week. And one of the things they were doing was they were shipping in LBMA 400-ounce bars in Arab ownership, recasting them into Chinese standard 4/9, 1 kilos, and then shipping them back to the owners, Arabs. For goodness sake, they could see back in 2014 which way things were going. So the idea that this is suddenly a surprise, no, it's not a surprise at all. the real money knew that this was basically going to happen at the end of the day. But I mean, whether it was going to be a violent transition or whatever, who knew? But anyway, China basically knew right from the outset, back in 1983, when they appointed the People's Bank of China as sole agent for the state in managing gold and silver resources, buying, selling, whatever, alongside its foreign exchange duties. They knew that they needed to accumulate gold and silver against the day when fiat currencies failed. I mean, we're going back 40 years, 43 years now, because that's when that legislation came in. I mean, I've got copies of it in English. So they've accumulated a lot of gold and silver off balance sheet, let's put it that way, rather than on, as part of PBOC's reserves. Mm-hmm. They got stacks of gold. And, the people who were only permitted to buy gold from 2002 when the SGE was open, they've taken delivery of some 28,000 tons. Now, admittedly, some of that's gone back in scrap, but it hasn't left the country. No gold was allowed to leave the country. If you wanted to take gold out, you had to get the permission of the People's Bank, which basically wasn't forthcoming, and of course the customs officials. 2 weeks ago, they turned round and said, you no longer need to seek our permission to export gold. Obviously, it's now just a customs matter. And of course, this opens up the link between the SGE and the new clearing and settlement system in Hong Kong. And furthermore, they have appointed refineries in Shenzhen to specifically recast gold for this new operation. It's all part of what eventually will be the monetization of gold, in the sense that the yuan will take over, if you like, as the settlement currency for gold transactions. Because if you look at what we're doing in the West, gold contracts, whether it's a futures contract or whether it's a forward contract, is not really a contract in gold. It's a contract in dollars. Mm. It's paper. And if the dollar's valueless, you don't have a market. And that's what they see. So they are setting up, if you like, the market which will take over from us. And already, they've taken most of the world's gold over there. The market's now going to follow. So that's what I see.
Rising sovereign debt ratios across major economies have reached unsustainable levels, rendering standard economic interventions ineffective. Attempting to support failing financial systems through continuous money creation will only accelerate currency debasement and trigger uncontrolled spikes in government bond yields. This monetary expansion is expected to destroy the purchasing power of paper credit, while causing widespread corporate insolvencies. In response, major foreign central banks are dumping dollar reserves to acquire physical precious metals and critical industrial raw materials. As new bullion clearing hubs emerge to facilitate direct trade, unbacked paper futures contracts will become obsolete, forcing a global return to gold-backed settlement mechanisms. Now, let's get back to the interview.
You're talking about this being bullish for gold. No, it's very bearish for fiat currencies. That's the key to understanding it. Yeah. So, the dollar's toast in this. Let me put it another way. The last real crisis we had, oil crisis, was the OPEC crisis of October 73 to January 74. If you look at what happened to inflation and what happened to bond yields, I can tell you that Japanese consumer price inflation ran at something like 25%. 25%. Bond yield went up to something like 8%. Where is it today? The 10-year bond yield is a bit below 3. The other difference, of course, is that in 1973, Japan's government debt to GDP was about 20%. Now it's 240%. And you've got similar numbers for all the G7 nations. We had 25% inflation in the UK, and we saw 10 to 15-year bonds, medium-dated bonds, we would call them in those days, the gilts, ran up, the yields went up to close to 17%. Where are we now? Knocking on 5. I mean, these bond yields are going to go a lot higher, and they're going to break the currencies. That's really what we're looking at. And it's happening. I mean, I wouldn't be surprised if we wake up one morning in the next few weeks and find that suddenly this is running away from us. Bond yields are running higher. And with debt to GDPs as we have at the moment, I mean, US 125%. If you look at, the UK is allegedly something like 95%. I think probably more like 100 and something. France is about 110, 115%. Italy is about 140%. Germany's sort of relatively good, but their economy is collapsing. So it'll rise, if you like, as the denominator goes wrong. That's looking at about 65. I mean, you're looking at debt to GDPs 5 times, at least, what they were the last time we had a similar oil crisis. We're going to see, I mean, this is Armageddon as far as these currencies are concerned. That is the key to understanding. And that's why you've got to get the hell out of credit, which includes currencies. Currencies are credit. They're not money. And get into real money, which is gold, and in a subsidiary role, silver. Silver is not even being priced at all as a form of money because you just look at industrial demand. And this is the other interesting thing, Andy. The Chinese have been keeping the price below $50 for a long period of time. I mean, just look at the export numbers. Ever since COVID, every year they've exported between 3,000 and 5,000 tons of silver, except in 2026, when suddenly they started turning around and becoming a massive importer. I mean, something like 1,628 tons in the first quarter of this year. I mean, we're looking at an annualized rate, which basically is going to correct, if you like, the the net exports of the last 4 or 5 years. China doesn't want dollars. And of course, the other thing is that when America turned around and decided that this was a critical mineral, China didn't particularly want to supply her with a critical mineral. So, I mean, the whole thing's a mess, a complete and utter mess.
A fundamental shift in international finance is dismantling the traditional fiat credit system. Decades of excessive money creation and mounting public debt have left Western currencies vulnerable to sudden valuation shocks. Monetary authorities are predicted to flood liquidity into weakening markets, a move that will inevitably spark hyperdepreciation, send borrowing costs soaring, and destabilize stock markets. Strategic trade powers are proactively decoupling from Western paper contracts by establishing physical gold vaults and settlement infrastructure in key international trade hubs. As paper currencies fail under the weight of unpayable debts, real physical commodities, primarily gold and silver, will regain their historical dominance as true global money. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.